Hey guys, so for today I wanted to go over another type of investment strategy. So this is perfect for individuals after you guys have originally set up the high yield savings and money market funds that I'd mentioned before. This is a great way to enhance that for one, better yield, and two, maximizing the ability to take advantage of upsides of the bond movements. So essentially, one of the key things to pay attention to is that last year we had rate cuts. This year we're expecting some more rate cuts as well, potentially two more, 1 to 2. When interest rates drop, bond prices will go up in value. And inversely happens when interest rates go up, bond prices will go down like they did in 2022. So I'll kind of go over that in a little bit. So why I wanted to bring this up is, not only because that's important to take advantage of opportunities, but also if you just have money sitting in your money market funds, you do want to take advantage of some potential upside because this does generally give you higher yields. Now, of course, always do your research. This isn't going to be the only type of investment strategy to take advantage of, but something to look into first. I'll make another video that goes over some safer options to kind of round out your diversification and make things a little bit smoother. So one of the key things to look into is from a company called State Street. The ticker symbol is TOTL, and this is their their total return ETF. So, one of the key things I always like to look into is, obviously things like yield, right? So the yield on this for SEC yield, always look at that. That's what you can expect in terms of your monthly interest is 5.12, higher than 3.4 from the money market fund that I showed previously. But the other thing to pay attention to is duration. So essentially the way that this calculation works is that for, in this case, 5.47, every 1% rate change will reflect a equal percentage of the price movement change. So let's say last year's rate change, let's just hypothetically say that it was 1%. Then the total price movement going up should have been 5.5. Now, last year's rate change was actually 0.75, so the total earnings of this should have actually been closer to 4%-ish, roughly, right? Like I said, I always go on Google, try to see what the one-year performance is. It only did 2.78, and actually the numbers might be a little bit closer to maybe 2.5, because if we got to include what it was by December 31st, rather than, because right now is January 9th. But looking at those numbers, comparing the interest rates, the total return of this only equaled 7.55. So the expected return should have actually made this closer to 9%. The fact that it only reflected a 7.55 means that in this case, this is an ETF. This isn't to inherently say that ETFs are worse than mutual funds. It's just that this is more driven by supply and demand. It's issued by these companies like State Street, but it's sold on secondary markets like the New York Stock Exchange. So the price movements was more reflective by how that moved on the markets versus the actual investment holdings. This isn't to say that that this is the same across the board with all types of investments, but just to kind of give you guys an idea in terms of how it works. Now, one of the other things I always want to go over is obviously the holdings, right? So most of this is going to be in something called the Treasury. It's considered one of the safest assets in the world, and mortgage-backed securities. So that's going to be the bulk of the holdings, including some corporate bonds as well. And the credit quality is important too. So anything that goes all the way down to Baa1, if you see capital letters, it's basically the S&P. So the S&P 500 is also run by the same company S&P, which oversees bond portfolios as well. That's what they do, these credit quality ratings. So most of it, as you can see, is in investment grade, almost 93%. My math is not so good, but that's what I'm assuming is roughly the number. So most of it's going to be in very safe asset classes. And then the final thing I always like looking into is under documents, summary prospectus. You always want to see what the year-by-year performance is. The main reason is you always want to assess risk. So in 2022, yeah, it was down negative 12%. That's a bit of an anomaly year. So typically bonds and stocks work inversely. So when stocks go up or when they go down, bond prices will work in the opposite direction. But bond prices were heavily impacted at that time. basically because inflation was a really rampant thing then, I'm sure you guys remember, so the Fed had to step in and increase rates. So ultimately, do your research. I'm going to show you some other funds that show some better safety net. Before I end the video, one quick thing that I did want to go over is another fund from PIMCO. This is the same type of fund, ticker symbol is PTRX. This yield is a little bit less at 4.5, but the duration is a little bit higher at 6.45. So that should roughly give you about a 4.83, about 5% return. Like I said, I always go on Google, see the 1 year performance. As you can see, it's not going to reflect this exact price change because 1 year right now is January 9th, but it did a 5.2% roughly based off of their calculations. So when you go back to the 1 year performance, it hit 10%. So this had outpaced the ETF. Once again, it's not a knock against ETFs. Sometimes ETFs do better than mutual funds, but mutual funds, generally speaking, in this case, they take advantage of the ability to be issued and bought and sold directly from the issuer. In this case, it's PIMCO. So it's more moved by the actual price. The price movements are more determined by the actual holdings of the investments. So one of the final things that I did want to share as well is obviously always do your research, always pay attention to this. This fund, one of the key things is that it is an institutional fund. So these are typically reserved for people who can put in $1 million into this, or you work with an advisor that happens to have this on their platform as well. So just wanted to break everything down. This is just an additional way for you guys to maximize your savings. I'll show another video that's a little bit of a safer option, but something for you guys to look into. Anyways, hope it helps. Bye.